Hey traders, this is Blake Morrow with Traders Summit. And you know it is Friday when I got Jim Welsh from Macro Tides here. Jim, how are you on this great non-farm payroll boom out of this world number? Do you believe the number? I mean, it's big.
Yeah. It's big. No, I don't believe the number.
Wait. Say that again. Now, explain. Why don't you believe the number?
I think it probably overstates the actual strength that's going on in the economy.
You
just
saying
like
we're China? I'm joking.
No. It's just, okay, leisure and hospitality, big increases. Well, we're opening up. People are traveling, going to hotels. They're going out to restaurants. So that part of it doesn't surprise me. I just think given the overall environment that we're in, and you know, I've been in the camp that I'm not sure I don't think we're in a recession. I'm not sure we're going to even have one in this year, but next year is a whole different ball game. I just think this number overstates the strength a little bit. But the economy is on decent footing. And a lot of people wanted to jump to the conclusion based on 1 + 1 = 2. Therefore, if you have 2 consecutive GDP negative prints, that means we're in a recession. Right. Case closed.
So you know, Jim, I've been talking to a lot of traders in our community and you know, suggesting that I think it might be a little too early before we start betting against employment data. And I mean, you follow the data way closer than I do, but you know, if you go back to, you know, the housing crisis, well, the GFC, the great financial crisis. Yeah. I mean, what's the difference between the quantitative easing that we did from that period in 2008, 7, 8, all the way until COVID versus what we've done in COVID? I mean, because what we did, the liquidity that the Fed and governments provided during the COVID period that we're just coming off of was unprecedented. What did those numbers look like?
Yeah. Well, the Fed's balance sheet in 2007 was $700 billion. After the great financial crisis, it jumped to like 4.5 trillion. And then remember, they tapered a little bit off.
Sure.
About 4.3 or so. And then it, you know, hit 8.9 trillion. So the Fed's balance sheet is up, I don't know, 12 to 13 fold. That's a big number. But the other thing that, you know, you and I've talked about this, Blake, and it ties into the point that you're making, is that and I've said this, the job market is the lagging indicator. The first thing in unemployment claims is in the middle. And then the thing we really want to look at is JOLTS and the number of job openings. So yeah, they went from 11.3 million to 10.6 million or 7, something like, I think it was 10.7. 75% of that was related to retail, 350,000, and 100,000 in construction. The two areas where we know there's some true weakness. But the point being is, after everything is said and done, that number is still way, way above the historical norm. So we're not going to see the employment numbers really reflect weakness until the beginning part of the pipeline, job wanted ads, if you will, really come down more. And they're going to come down more. But businesses, we talked about this, I think, a couple of weeks ago. If I'm running a company and I'm reading recession talk, well, maybe instead of hiring the 10 people I thought I was going to hire, I only hire 5. And then if things start to really slow in my business, I cut back people's hours because I'm trying to avoid laying off my good employees. Yeah. So that's why it's a lagging indicator. But I think there's just this mindset. Everyone wants to, you know, some of it's political. Let's criticize Biden. We're in a recession. We're in a recession. And I think there was hope by a lot of people, Blake. Yeah, we're going to see the job number weaken because that'll just prove my point. I mean, come on now. It doesn't work quite like that.
And you know, I like to explain this concept to a lot of people that we come into contact with. You know, at my age, being that I'm about 50 years old, I turned 50 this year, by the way. And then, you know, at your age, which is older than me, but you know a lot of people that own their own businesses, and America is made up of a lot of small business owners. And every business owner that I talk to is extremely intelligent for the most part, you know, give or take the couple bad apples out there.
You can't be a complete idiot. Yeah.
But they're running companies with multiple employees, some in the hundreds. And they're people that I know, and they obviously stay right on top of the news, just like we do. In this environment, in the day of in the information age that we are in, the CEOs watch what's happening. And so to your point, everybody's paying attention to the data. Everybody's looking around, and everybody's, making their decisions based on what we see as economic data. But as you also pointed out, and to your point, that balance sheets are still, and you have talked about this, that balance sheets still are very, very good in the U.S.
Consumers still have a lot of savings. Now that's
consumer and
upper income
corporations.
people. And what I've written is like, hey, the bottom 20 to 40%, the last 6 months are really getting squeezed by food, energy, and shelter costs. Companies have a lot of cash on their balance sheets. Now, again, that's skewed. Microsoft, Google, Apple have tons of cash, but it filters down that even, a company with 500 million, which is obviously big if you're, a small businessman, but so the balance, the economy has some reserves to withstand higher rates. And the other thing I'll point out is that if you look at the Fed funds rate adjusted for the CPI, we're at -6%, folks. So to suggest that the Fed is tight is silly. And I think what we've seen, and I wrote about this, that on Monday, that you're going to come and see the speakers of the Fed come out and push back hard against the idea that the Fed is pivoting and so forth. And we had, it's like everyone is out there. Neil Kashkari, Daly from San Francisco, who are normally dovish, they're talking the hawkish game. So basically the whole idea was we're going to get to neutral as fast or as expeditiously as possible and then see how things look. Well, right now, the PCE came in for June. It was much hotter than expected. You get this job number, even if it's heavy by a couple 100,000, it's still a pretty decent number if one wants to discount the headline number. So my point is, from the Fed's perspective, now we need to go above neutral. And that's been the messaging. We got to go to 3.25 to 3.5 by the end of this year. And Fed funds futures, have been pricing in a decline, that the Fed would start cutting rates next year. So my point is just that the economy is in better shape than I think a lot of people want to give it credit for. It's going to continue to slow. In my mind, there's no doubt about that. The Fed has tightened financial conditions. But ironically, the rally in stocks, the decline in treasury yields, decline in mortgage yields, the decline in gas prices obviously start to unwind some of the financial tightening and squeeze on consumer spending. Well, people are going to have a few more bucks left over than they did a month or two ago when they fill up their gas tank.
Yeah.
So it's like we're self-correcting. We're going to slow more, but I don't believe we're going to fall off a cliff.
And sentiment will improve too, as the beatings of inflation slow down, right?
Yeah.
As the whippings.
Yeah.
Hey, I know we could sit here and talk for hours regarding this.
Yep.
But let's get into some of your charts that you brought today, and I want to share them make sure that everybody's got a good view of them. Let's take a look at you brought the first one at the NBER. What is this?
Okay, the National Bureau of Economic Research. This is the outfit that dates the official beginning and end. And people criticize them. Well, man, there could be 6 to 12 months after the event. They're not a forecasting outfit, folks. They're like a historian. They're going to date for posterity when a recession began and why, what indicators were they looking for them to make that call, and when it ends. If we look at the primary variables, and they do not just look at GDP, they look at a broad swath and these are those areas. And what we can see is, guess what? None of them are contracting. Right. So as I said last week, and really for weeks now, they will never come out and say that a recession, if we go into recession sometime in the next 6 to 12 months, it will not have started in the first quarter. Absolutely.
As you made the case last week that it most likely started this current quarter, the second quarter.
Maybe. Some of the numbers are going to get revised upward. The trade number for June came in. It was down, the deficit was down 5 to 7%. Well, that'll add back to GDP because they subtract imports. But nonetheless, the whole point is, if for those who just want a simplistic definition, great, you go to town with that. But if you really want to try to get it right and understand what's going on in terms of the dynamics supporting the economy, you just got to learn more. It's that simple, but a lot of people like to shortcut. So this pushes back, I think, very strongly. Yeah, if we go into recession at some point in time, 6 to 12 months from now, they'll talk about it. but it won't be in the first quarter, and it may not even be in the first half, given the strength in these numbers.
All right.
Okay, let's jump to the second.
let's take a look
Yeah.
at your view of job growth here. So what is this?
Okay, basically it's going back to 1947 and looking at other periods of time where what happened with job growth. And what you can see, look at the average, that's the yellow line. In terms of at this point in time, job growth is usually negative. If we're going into a recession, as people said in the first quarter, well, look at job growth. Obviously, that number is going to go up with the current print. So again, my only point is it's one thing, job growth in the first quarter was 392,000 per month. So you're starting from a very high level relative to the other business cycles that are shown here. And it's just going to take, to the point you made, Blake, it's just going to take more time for this thing to slow down materially. And to me, this chart proves that point.
And I was going to say, one of the things about this chart that really shows me is that we are in some unprecedented times, aren't we?
Yeah, we are. And again, it goes back to the amount of stimulus, Fed's balance sheet. The federal government sent out $6 trillion. That money hasn't all dissipated. So there's a lot of reasons to lean against the rush to say, oh, we're in a recession. Oh, my goodness. To me, I'm just trying to keep an objective point of view and look at the things that are pluses and minuses. And to me, the balance is, we didn't go with the economy didn't contract in the first quarter, and it may not have contracted even in the second quarter.
All right. Well, the next chart you brought up is the Fed funds futures for December 9th, 2021. Yeah. Yeah.
And the reason is so many people I see on Twitter and stuff talking about, well, the Fed funds futures are pricing in a recession because they say the Fed's going to cut rates next year. They were looking for the Fed to cut rates in March of next year. Whoa, wait a second. You're assuming that markets get it right. And to me, this is like a kind of a damning thing. On December 9th of last year, the Fed funds futures were pricing in 3 quarter-point hikes for all of 2022.
They kind of got it wrong.
Just a little bit, And the amazing thing, though, Blake, is we had already learned that inflation was at a 39-year high. And Chair Powell in November came out and said, hey, I think it was November 3rd or so, that inflation finally conceded. Inflation isn't going to be as transitory as we thought. It's going to last longer. So my point is this market was armed with information, 39-year high in inflation, Chair Powell's shifting policy. And this is the best they could see. So this is a joke. But now those who are in the recession camp and all, oh yeah, the Fed's going to pivot. They're pointing to the curve of the Fed funds futures as kind of like the foundation of their whole argument. And my point is, guys and gals, the markets are often wrong about this stuff. And if this doesn't prove that point, I'm not sure what will. It's kind of like the S&P, it was at 4,800 in January. What was it discounting, folks? But now the market's rallying. So it's looking through this little dip in the economy and it's seeing how everything's going to get better. I mean, it's amazing, Blake, to me, to listen to what I hear on TV by people that are supposedly knowledgeable saying this kind of stuff. And unfortunately, none of the anchors ever push back. Everybody just nods. Markets are a discounting mechanism. They're looking out 6 months into the future. It's complete hogwash.
Well, it's an interesting point you bring, and the one thing that I want to reiterate is the market gets it wrong, and they've had it wrong. Yeah. So
I mean, if this isn't a gross example, anyway, all right.
Yeah, all right. So next chart is the TLT. So how are you viewing this, and what are you gonna how are you gonna trade it?
Okay. Well, basically, when we talked last week, I said potentially the TLT had kind of traced out an ABCD triangle, and that we would get a pop. And my bias was to sell into that pop. And this past Monday, August 1st, the weekly technical review, I suggested selling into the opening. And it traded the prices are up there. Back in mid-June, June 16th, I sent out a special update, time to buy bonds, because I think we're going to see weaker economic data and things are overdone to the downside. And we had completed 5 waves down from 155, or potentially. we're at an interesting juncture here, Blake, because it's possible we just did an ABC and that this is wave 4 and the TLT is going to a lower low. My bias is it's more likely that we finished an ABC up for a wave A. We're going to get a pullback maybe to 114-ish, maybe a little bit deeper. I have to figure out what the 618 retracement is and all that happy stuff. And then that'll be a B wave. And then we're going to see a C wave rally that does get up towards that 125 level. But that's why I just thought, you know what? I think we've completed something here. It's time to take some profits, step aside, and let's see what shows up.
Well, that was a great call from last week. And I know we've been covering TLT, or you've been covering TLT rather, on a weekly basis. The next chart, now this is an interesting one, Jim, is gold, because man, there are a lot of gold bugs. And I know you were talking about an all-time high. We're going to an all-time high today. Obviously, got the brakes put on gold a little bit because of the data. So what are you thinking here?
First and foremost, you know, as we talked last week, to me, there was a very high probability at 1850 or so, maybe even 1920. Once we get there, if gold gets there, obviously, and happens next, will determine whether we can really anticipate new all-time highs. I just thought that buying gold in the low 1700s was going to be a profitable trade up towards at least 1850, 1880. What's encouraging to me, Blake, is for the first time, you can see, I'm sorry, these are small little numbers here. I should have focused just there, but you can see from the low last week, 1, 2, 3, 4, 5. So for the first time in a very, very long time, you can see clearly a 5-wave rally. That reinforces the idea, because, you know, over the last 2 or 3 weeks, we've been talking, the idea that gold dropped from 2070 in August of 2020 to 1680 or 77 in March of 21. Then we rallied up to 2067 at that B designation in March of this year. And we've completed a wave C. So that was the supposition going in and why it made sense to buy gold as it was declining over the last month or so. This 5-wave rally adds more credibility to that. That was a bottom. We're getting a wave 2 pullback, but I think we're going to see gold resume its uptrend and make that move up towards the 1850, potentially 1880. And then we'll see, you know, we'll cross that bridge when we get there.
All right. Well, I know a lot of gold bulls are like, but are we going to go to all-time highs? So it's going to be interesting to find out if we do or not. So let's take a look at your last chart, which is the S&P. Yeah. Big rejection today. You know, obviously we're in that regime, as everybody knows. Bad data is good. Good data is bad. We had good data. Stocks, you know, came down. I mean,
Well,
pretty simple, I guess.
Yeah. Well, unfortunately, that's where we are. The reality is, especially if you're thinking that the Fed's about to pivot. Oop, got a little cold water thrown on that parade, right?
Right.
When we talked last week, the S&P had traded up to 41.45. My thought was that we were going to see one more pop to complete this move up, at least from the July low, and that we would see a pullback towards 3,900, at least 3,950 to 3,900, with an outside chance of 3,800. So again, if we get more data points that people are like, whoa, wait a second, we were completely off sides and thinking that the Fed was about to pivot, you could see a very sharp break, because you had a lot of momentum players jump on this the last 2 or 3 weeks. And if 10-year yields jump to 305, 310, you know, again, all of it comes together and you unwind some of the jumping on the bandwagon trade that we've seen.
Well, I was going to say technician to technician, Jim. I think the 4080, which is this week's lows, basically, that's pretty key support, right?
Yep. I mean, if there's one more rally up, and it's possible, you could see 1, 2, 3. This pullback is a 4 of wave 5. One more pop. If you get above 41.68, that's a place to go short. You get below like you just talked about, the 4,080, 4,075-ish. You get below that, that's a place to go short. Wow. Because I believe we're going down toward at least 3,950 to 3,900. And then we'll see what happens and the manner in which it does, in fact, decline.
So
Assuming that it does.
and what it seems like here, Jim, is in either scenario, you're looking to sell, and
Yeah.
you know, it's been a nice ride. I mean, you know,
Yep.
percentage wise, it's been a nice ride off the lows. I think you've been on the right side pretty much for the last month and a half. So,
Yep.
you know,
Yeah. No, it went a little bit further. I was looking for 4,030-ish. You know, that was two legs equal and all that happy stuff. We pushed beyond that.
yeah.
But again, I look at that, Blake, is yeah, we pushed beyond that, but I think on a false premise. So if the market had pushed beyond 4,030 on its own, as opposed to, oh, the Fed's going to pivot and all that, then it would have been to me more legitimate and like, wow, okay, this is the kind of strength that one needs to kind of believe in, as opposed to, no, I'm questioning this strength because I think people are wrong, at least at this point in time.
All right, Jim. Well, you know, I'm going to ask everybody at home, if you love this exclusive content from Jim, make sure you give him a thumbs up on if you're watching us on YouTube. Subscribe to the channel, the Trader Summit channel, so you don't miss any of this very exclusive content that we have every week with Jim. And Jim, if I'm watching you at home and I'm like, man, this guy's been on the spot, how do I find out more about you? And
Macrotides.com. There's more information there. And no, the next 6 months, I think, are going to be really, really more dynamic and in a way more interesting, just because of the jockeying between what the Fed may or may not do and how the markets interpret it.
Well, this is the best place to be every Friday, that's for sure. So, Jim, thank you so much for spending your time with our community, and we'll see you next Friday.
All right, my pleasure, Blake, and have a wonderful weekend.
You do the same. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.